Every investor who has ever put money into the stock market has felt the pull of a hot tip, a gut feeling, or the fear of missing out on the next big thing. Every investor has also, at some point, watched a confident decision turn into a painful loss, wondering what went wrong, wondering why the logic seemed so clear at the time, and yet the result was so different from what was expected. This feeling, this gap between intention and outcome, is one of the oldest stories in the world of money, and it is exactly what one of the most important works ever created about investing sets out to explain and fix. What we are exploring today is called What Works on Wall Street, written by James P. O'Shaughnessy, a man who spent decades digging through vast amounts of financial data, studying what actually works in the stock market over long periods of time, not what feels right, not what makes sense in theory, but what the numbers prove over and over, through bull markets and bear markets, through economic booms and crashes, through times of fear and times of greed. James O'Shaughnessy believed in something very simple, but very powerful. He believed that the stock market, despite all its noise and complexity, follows certain patterns that repeat themselves across time. He believed that investors who understand these patterns and follow them with discipline, ignoring their emotions and sticking to a proven system, will outperform the vast majority of investors in the long run. And he spent years of research, testing strategy after strategy against historical data going back many decades to prove this belief. What makes this work so important for investors is not just the conclusions it reaches, but the process it uses to reach those conclusions. O'Shaughnessy does not rely on opinions or theories. He relies on data. He tests every strategy rigorously, looking at how it performed across different market cycles, different economic conditions, and different time periods. This kind of evidence-based approach to investing is rare, and it is exactly what separates long-term winners from long-term losers in the stock market. So if you are someone who wants to grow your wealth through investing, if you want to understand what truly drives stock market returns, if you want to learn from decades of data rather than from guesswork, then what follows is for you. Let us go deeply into the ideas, the strategies, and the wisdom that O'Shaughnessy uncovered, and let us do it in a way that is clear, direct, and useful for investors anywhere in the world. The very first thing O'Shaughnessy wants you to understand is why most investors fail. Not because they are stupid, not because they are lazy, but because they are human. Human beings are wired in ways that made perfect sense for survival thousands of years ago, but that work against success in the stock market today. We are wired to follow the crowd, because in the ancient world, if everyone was running from something, you should probably run too. We are wired to feel losses more painfully than we feel equivalent gains, because in the ancient world, losing food or shelter could be fatal, while gaining the same amount was simply nice. We are wired to look for patterns, because in the ancient world, recognizing patterns helped us survive. And we are wired to trust our own judgment, because in the ancient world, experience and instinct were our best tools. All of these instincts, while useful for survival, become serious problems when we apply them to investing. Following the crowd means buying when prices are high and selling when prices are low, which is the opposite of what successful investing requires. Feeling losses more painfully than gains means we hold on to losing investments too long, hoping they will recover, and sell winning investments too early, afraid of losing the gains we have made. Looking for patterns means we see trends in random data, convincing ourselves that a stock that has gone up 5 days in a row will continue to go up, or that a manager who has had a good 3 years has some special skill that will continue to serve him. And trusting our own judgment over systematic evidence means we ignore data and follow our gut, which is almost always wrong in the complex and unpredictable world of financial markets. O'Shaughnessy calls this the tyranny of the individual case. We are all far too influenced by specific examples, by stories, by things we have personally experienced, and far too dismissive of large-scale statistical evidence. We hear about someone who made a fortune by following their instincts on a particular stock, and we think, maybe I can do that too. We do not pay attention to the thousands of people who tried the same thing and lost money. We see a fund manager who has beaten the market for 3 years and assume it is skill, when the data shows it is almost certainly luck. We feel like we know things that the numbers cannot capture, when in reality, the numbers almost always know more than we do. This is the foundation of everything O'Shaughnessy teaches. You must replace your subjective, emotional, and instinct-driven approach to investing with an objective, systematic, and data-driven approach. You must stop trusting your gut and start trusting the numbers. This is not easy. It goes against everything that feels natural. But it is the only path to consistently superior investment returns over a lifetime of investing. Now, having established why most investors fail, O'Shaughnessy moves on to what actually works. And to understand this, we need to start with something called stock market data. O'Shaughnessy used a comprehensive database of stock market information going back to the 1920s, tracking thousands of companies across decades of market history. He tested dozens of different strategies, looking at which factors, which characteristics of stocks, were actually able to predict future returns. He looked at things like price-to-earnings ratios, price-to-book ratios, price-to-sales ratios, price-to-cash flow ratios, dividend yields, earnings growth, sales growth, and many other measures. He tested each of these factors individually, and he tested combinations of factors together. And the results he found were eye-opening for anyone who cares about growing wealth through the stock market. Let us start with one of the most fundamental concepts in all of investing, the idea of value. Value investing is the practice of buying stocks that are cheap relative to some measure of their underlying worth, and selling or avoiding stocks that are expensive relative to that same measure. The theory is simple. If you consistently buy things when they are cheap and avoid things when they are expensive, you should do better than if you buy things randomly or chase things that are already expensive. But does this actually work in practice? O'Shaughnessy tested this rigorously, and the answer is yes, but with important qualifications that every investor needs to understand before acting on this insight. One of the most common measures of value is the price-to-earnings ratio. This is simply the price of a stock divided by the earnings per share of the company. A stock with a price-to-earnings ratio of 10 is considered cheaper, in relative terms, than a stock with a price-to-earnings ratio of 30, because you are paying 10 times the annual earnings in the first case and 30 times in the second case. The conventional wisdom is that low price-to-earnings stocks are better investments than high price-to-earnings stocks. O'Shaughnessy tested this across many decades of data. The results showed that yes, stocks with low price-to-earnings ratios did tend to outperform stocks with high price-to-earnings ratios over long periods of time. But the advantage was not as dramatic as many people would expect, and more importantly, the strategy worked much better when applied to large-cap stocks than to small-cap stocks, a distinction that turns out to be very important in practice. Let us understand what large-cap and small-cap mean, because this distinction matters enormously in O'Shaughnessy's framework. Large-cap stocks are stocks of large companies, companies with a market value, meaning the total value of all their shares combined, that is very high. Small-cap stocks are stocks of smaller companies with lower total market values. O'Shaughnessy found that many of the classic value strategies worked much better when applied to large, well-established companies than when applied to smaller, less established ones. This is an important finding because many investors assume that small companies offer better opportunities for big gains. And while that can sometimes be true, the data shows that applying value strategies to small companies is much riskier and much less reliable than applying them to large companies, particularly over the time periods that most investors actually experience in practice. Now let us go deeper into the different measures of value that O'Shaughnessy tested. because not all measures are created equal, and some are dramatically better predictors of future returns than others. The first major value measure we have already discussed is the price-to-earnings ratio. As mentioned, this measure does predict future returns to some degree, particularly for large-cap stocks. Stocks with low price-to-earnings ratios tend to outperform stocks with high price-to-earnings ratios over time. But there are important limitations to this measure that every investor should understand. Earnings can be manipulated by clever accounting choices. A company can show higher earnings in a given year by making certain accounting decisions that make the current year look better at the expense of future years. This means that price-to-earnings ratios can sometimes be misleading. A stock might look cheap based on its price-to-earnings ratio, but that might be because the earnings are artificially inflated and will fall in future years, making the stock much less cheap than it appears on the surface. The second major value measure is the price-to-book ratio. Book value is essentially the net worth of a company on paper, the total value of its assets minus its liabilities, according to the accounting records. A stock with a low price-to-book ratio is one where you are paying a low price relative to the company's stated net worth. This is another classic value measure, and O'Shaughnessy found that it also has some predictive power, meaning stocks with low price-to-book ratios do tend to outperform over time. But again, book value can be misleading in the modern economy. In today's world, many of the most valuable things a company owns, things like brand recognition, software code, intellectual property, customer relationships, and the talent and knowledge of its employees, do not show up on the balance sheet at all, or show up at very low values that bear little relation to their true economic worth. So a company with a high price-to-book ratio might look expensive, but actually be reasonably priced when you consider its true assets in full. The third major value measure, and the one that O'Shaughnessy found to be the most powerful of all, is the price-to-sales ratio. This is the price of a stock divided by the annual revenue per share of the company. Unlike earnings, revenue is very difficult to manipulate. You cannot create sales out of thin air through accounting tricks the way you sometimes can with earnings. Revenue is also more stable than earnings from year to year, because earnings can swing dramatically due to one-time charges, write-offs, tax changes, and other items, while revenue tends to be more consistent and more reflective of the actual level of business activity. O'Shaughnessy found, after testing across many decades of data, that the price-to-sales ratio is the single most powerful predictor of future stock returns available to investors. Stocks with low price-to-sales ratios, meaning stocks where you are paying a low price relative to the company's annual revenues, consistently outperformed the market over time, and did so by a margin that was larger than any other single value measure he tested. This is one of the most important findings in the entire book, and it is worth dwelling on carefully because it has enormous practical implications for how you think about building a portfolio. Why is the price-to-sales ratio so powerful? O'Shaughnessy believes it is because sales, or revenue, is the most honest and hardest to manipulate measure of a company's business activity. When a company generates a certain amount of revenue, that is real economic activity happening in the real world. It cannot be easily inflated by accounting choices or management decisions. And when the market is pricing a stock at a very low multiple of its revenue, it often means the company is being ignored or has temporarily fallen out of favor with investors, creating a genuine opportunity for disciplined value investors who are willing to look where others are not. The fourth value measure O'Shaughnessy tested in depth is the price-to-cash flow ratio. Cash flow is the actual cash that a company generates from its business operations, which is often considered a better measure of financial health than reported earnings, because earnings can be influenced by non-cash items like depreciation, amortization, and other accounting adjustments. Cash flow tells you how much real money is actually flowing into the company from its operations. O'Shaughnessy found that stocks with low price-to-cash flow ratios also tend to outperform over time, though the advantage is somewhat less consistent than that of the price-to-sales ratio when measured across the full breadth of his historical data. The fifth value measure is dividend yield. This is the annual dividend paid by a company, expressed as a percentage of the stock price. A high dividend yield means you are getting a large dividend payment relative to the price you paid for the stock. High dividend yield stocks have long been associated with value investing, and O'Shaughnessy's research confirms that they do tend to outperform over time. However, he found that the advantage of selecting based on dividend yield alone was smaller than many people expected, and that dividend yield worked better as part of a combined strategy than as a standalone measure for portfolio construction. Now, having looked at value measures in some depth, let us turn to something completely different but equally important. One of the most surprising and at times controversial findings in O'Shaughnessy's research is the power of what is called price momentum, or relative strength. Momentum is the idea that stocks that have been going up recently tend to continue going up for a while, and stocks that have been going down recently tend to continue going down for a while. This sounds like the opposite of value investing. If value investing says, buy what is cheap and unloved, momentum seems to say, buy what has already gone up in price and is now more expensive and more popular. How can both of these ideas be true at the same time? The answer, which O'Shaughnessy demonstrates clearly with decades of data, is that they work over different time periods. Value factors like price-to-sales ratios tend to predict returns over long periods of time, like 3 to 5 years or more. But momentum factors tend to predict returns over shorter periods of time, like 6 to 12 months. Over the long run, cheap stocks outperform expensive ones as the market eventually corrects its mispricings. But in any given year, stocks that have been going up tend to continue going up, and stocks that have been going down tend to continue going down because investor sentiment and capital flows take time to reverse. This means that combining value and momentum can give you a powerful combination, identifying stocks that are both genuinely cheap relative to their fundamentals and also showing positive price momentum. The value factor ensures you are buying something that is underpriced by the market. The momentum factor ensures that you are not buying into a falling knife, a stock that is cheap but still declining in price because something is genuinely wrong with the business. O'Shaughnessy tested relative strength extensively across his database. He found that measuring the 12-month price return of a stock, meaning how much it has gone up or down over the past year in percentage terms, is a powerful predictor of its returns over the next 6 to 12 months. Stocks in the top tier of 12-month performance tend to outperform the market over the following year, while stocks in the bottom tier tend to underperform. This finding is robust, meaning it holds up across different time periods, different market environments, and different sectors. The market has a strong tendency to continue moving in the direction it has been moving, at least in the short to medium term, before eventually reversing. This is why momentum is such an important factor in O'Shaughnessy's best strategies. It acts as a filter that helps eliminate what investors call value traps, the stocks that are cheap for a good reason and that continue to fall even as they look increasingly attractive on paper based on their fundamental ratios. By combining value with momentum, you can identify stocks that are cheap and showing signs of life in the market, rather than stocks that are cheap and still falling because the market knows something that the raw valuation numbers do not capture. Let us now talk about the specific strategies that O'Shaughnessy developed by combining these various factors, because the combinations are where the real power of his approach is concentrated. The individual factors each have some predictive ability on their own, but when you combine the right factors in the right way, the result is significantly more powerful than any of the individual pieces. One of the most important strategies O'Shaughnessy developed is what he calls the cornerstone value strategy. This is designed for large-cap stocks, meaning it focuses on the biggest and most established companies in the market. The strategy selects stocks from among the largest companies in the database, those with very high total revenues, and applies several filters to identify the ones that are most attractively priced relative to their fundamentals. The specific filters include selecting stocks with above-average revenues, above-average numbers of shares outstanding, strong cash flows relative to the overall market, high dividend yields compared to other large companies, and positive 12-month price momentum. The result is a portfolio of large, established companies that are undervalued by the market on multiple measures and that are beginning to show positive price momentum as investors start to take notice. Why does this strategy work so well? Because large companies with high revenues and strong cash flows are by definition established businesses with real track records. They are not speculative bets on unproven ideas or early-stage companies that might or might not succeed. And when such companies are also trading at valuations that are low relative to their earnings and cash flows, and paying high dividends to their shareholders, it generally means the market has, for some reason, become pessimistic about them. In many cases, that pessimism is temporary, driven by one or two disappointing quarters or a short-term business challenge, and the stocks eventually recover to reflect the true long-term value of the underlying businesses. Adding momentum as a filter helps ensure that you are buying companies where that recovery is already beginning to unfold, rather than companies where the pessimism is still deepening. O'Shaughnessy found that the cornerstone value strategy significantly outperformed the overall market over long periods of time. The outperformance was not dramatic in any single year, and there were certainly years of underperformance along the way. But compounded over many years and decades, the consistent small edge that the strategy delivered made an enormous difference to the final wealth of investors who followed it with discipline. The second major strategy is what O'Shaughnessy calls the cornerstone growth strategy. While the cornerstone value strategy focuses on large, established companies that are cheap, the cornerstone growth strategy focuses on smaller companies that are growing strongly but are still attractively valued by the market. The key filters for this strategy are a low price-to-sales ratio, meaning the stock is cheap relative to its revenues, strong earnings growth over a sustained period, meaning the company is genuinely growing its profits and not just showing a one-time boost, and strong 12-month price momentum, meaning the stock has been going up in price recently and investor sentiment is improving. The price-to-sales filter is absolutely crucial here because, as we discussed, it is the most powerful value measure O'Shaughnessy found. Applying it to smaller, growing companies helps identify those that are genuinely undervalued by the market and have real growth potential, rather than simply being cheap because they are low quality, struggling, or declining. The earnings growth filter ensures that the company is actually growing its business at a meaningful rate, not just looking cheap because its business is stagnant or shrinking. And the momentum filter ensures that the market is beginning to recognize the value of the company and reward its stock accordingly, rather than the stock continuing to fall despite looking attractively priced on the surface. O'Shaughnessy found that the cornerstone growth strategy was among the highest returning strategies in his entire research database, outperforming the market by a very significant margin over long periods of time. However, he also found that this strategy was considerably more volatile than the cornerstone value strategy, meaning it had more dramatic ups and downs along the way, with some years of very strong outperformance and some years of meaningful underperformance. Implementing this strategy therefore requires investors to have a strong stomach, a long time horizon, and the discipline to stick with the strategy through those periods of underperformance without losing faith in the underlying logic. This brings us to one of the most important themes of the entire work. The best strategies are not necessarily the easiest to follow. In fact, there is often an almost frustrating inverse relationship between how good a strategy is over the long run and how comfortable it is to implement in the short run. The best strategies tend to involve buying stocks that are unloved by the market, that have had recent problems, that most investors are actively avoiding. They involve holding those stocks through periods when they look even worse than when you first bought them. And they involve systematically selling stocks that have done well and replacing them with stocks that currently look less attractive on the surface, even when every instinct says to hold on to the winners and avoid the losers. This kind of discipline is extraordinarily difficult for most investors to maintain over time. It is why the best strategies are available to everyone through publicly accessible information, yet very few people actually benefit from them consistently over long periods. The information is not secret. The strategies are not hidden away. But sticking to them through the inevitable periods of pain and doubt requires a level of emotional discipline that most investors, even experienced and intelligent ones, simply do not have in practice. O'Shaughnessy is very clear and very honest about this throughout his work. He says that an investor who truly commits to a systematic, disciplined strategy, who does not deviate based on fear or greed or the endless noise of current events and market commentary, will almost certainly outperform the vast majority of investors over the long run. But he also acknowledges that this is much easier said than done, and that most investors, even those who understand the logic deeply, will eventually abandon their system at the worst possible moment, usually just before it begins to recover and outperform again. Now let us go back and explore some of the more specific findings from O'Shaughnessy's research, because there are many important insights beyond the core strategies that deserve the careful attention of every investor. One of the most striking findings in the book concerns the performance of what people call growth stocks. Most investors are familiar with the concept of growth investing, the idea of buying stocks in companies that are growing rapidly in terms of revenues, earnings, and market share. Technology companies are often growth stocks because they are expanding fast and attracting enormous investor enthusiasm. The problem, as O'Shaughnessy's data shows clearly, is that growth stocks as a broad category consistently underperform the market over long periods of time. This seems deeply counterintuitive. If a company is growing fast, why would its stock underperform the overall market? The answer is entirely about price. When a company is growing fast, investors get excited, and they bid up the price of the stock to very high levels relative to the company's current revenues and earnings. They are willing to pay 50 times, 80 times, even 100 times earnings because they expect the company to continue growing rapidly for many years into the future. But these expectations are almost always too optimistic in practice. Companies rarely grow as fast for as long as investors hope when they are in a state of excitement, and when growth slows down, even slightly, the disappointment can cause the stock to fall dramatically and quickly. This is why high price to earnings, high price to sales, and high price to book stocks, as a group, consistently underperform the market over long periods. The expectations embedded in their prices are simply too high to be met by the actual subsequent performance of most businesses. On the other side of the coin, value stocks, those with low price to earnings, low price to sales, and low price to book ratios, tend to be stocks in companies that are going through difficulties, that are out of favor, that investors are actively avoiding. Because expectations for these companies are low or even negative, it does not take much improvement or good news to cause the stocks to perform well. When a company that everyone has written off turns out to be somewhat better than expected, the stock can rise significantly because the bar was set so low that any positive surprise generates a meaningful positive reaction. This is the fundamental psychological insight behind value investing, and O'Shaughnessy's data confirms it powerfully and consistently across many decades and many different market environments. Not always in any given year, but consistently over long periods, buying cheap is better than buying expensive, regardless of the surface-level reason for the cheapness. The market consistently overestimates how good the good companies will continue to be and underestimates how much the struggling companies will eventually recover. Patient value investors profit from both of these tendencies simultaneously. Another important and perhaps surprising finding concerns the performance of initial public offerings, which are commonly called IPOs. An IPO is when a company first sells its shares to the public, transitioning from being privately owned to being publicly traded on a stock exchange. IPOs are often associated with excitement and the potential for high returns, because early investors can sometimes make a lot of money if the stock price rises dramatically in the immediate aftermath of the company going public. But O'Shaughnessy's data tells a very different story over longer time horizons. Over long periods of time, IPOs as a group dramatically underperform the broader market. The reason is the same dynamic we just discussed with growth stocks. Companies that are going public for the first time are usually in the middle of a period of rapid growth, and the investment banks that manage the IPO process have every incentive to maximize the offering price. Investors get excited and bid up the prices to very high levels in the initial period. But when the growth inevitably slows down, or when the company faces the competitive realities and reporting requirements of being a public company, the stocks often fall significantly and sometimes never recover their original levels. O'Shaughnessy advises investors to be very cautious about IPOs, despite the excitement and media attention that surrounds them. The data clearly shows that the lottery ticket mentality that many investors bring to IPOs, the belief that they might be getting in on the ground floor of the next enormously successful company, is rarely rewarded in practice over the long run. For every genuinely transformational company that succeeds spectacularly after its IPO, there are many more that disappoint investors who paid high prices based on high hopes. Let us now talk about some of the specific market patterns and phenomena that O'Shaughnessy explored, because they provide fascinating and practically useful insights into how markets actually function over time. One of the most well-known recurring patterns is what is called the January effect. The January effect is the observation that smaller cap stocks tend to perform particularly well in the month of January, year after year, across many decades of market history. The explanation for this is related to year-end tax loss selling. Many investors sell their losing stocks in December to capture tax losses on those positions, which reduces their taxable investment income for the year. This concentrated selling pressure pushes the prices of smaller cap stocks down in December, often below their fair value. Then, in January, when the selling pressure is gone and investors begin reinvesting their money and looking for opportunities, the prices of these stocks tend to bounce back toward more reasonable levels. O'Shaughnessy confirmed the existence of this effect in his data and showed that it can be a meaningful source of returns for disciplined investors who understand it and position their portfolios to take advantage of it systematically. Another important phenomenon is the tendency of stocks that have fallen significantly in price to eventually mean revert, meaning to gradually bounce back toward their historical average valuations over time. This is related to the value effect, but represents a more extreme form of it. Stocks that have fallen by 50% or more from their recent highs are sometimes called fallen angels by investors, and O'Shaughnessy's data shows that as a group, they do tend to eventually recover significantly, though the recovery can take many years, and the volatility along the way can be very extreme, making them psychologically difficult to hold. The principle behind this is the same as value investing more broadly. When a stock falls dramatically, the expectations embedded in its price become very low, and even modest improvement in the underlying business can generate meaningful positive returns for patient investors. Now let us talk about one of the most consistently debated topics in all of investing, the question of whether active fund managers can truly beat the market consistently over time. This is the classic debate between active management, where fund managers try to select individual stocks that will outperform the market, and passive management, where investors simply buy a fund that tracks the entire market index without trying to pick specific winners. O'Shaughnessy's data is very clear on this point, and his conclusion aligns powerfully with the growing consensus in the investment research world. The vast majority of active fund managers fail to beat the market over the long run after accounting for the fees they charge. The few who do beat the market in any given period usually fail to sustain that outperformance consistently in the following periods. The data strongly and repeatedly suggests that most of the outperformance achieved by active managers in any given period is the result of luck rather than genuine and reproducible skill. This finding has profound implications for investors everywhere. If most active managers cannot reliably beat the market over long periods, then why pay their substantial fees? O'Shaughnessy's answer to this question is nuanced and important. He does not simply say to give up on active management entirely and buy index funds that track the market. Instead, he argues for a very specific type of active management, the kind that is disciplined, systematic, and rules-based, the kind that sticks to a proven strategy grounded in the historical data and does not deviate based on emotions, short-term market noise, or the particular biases and judgments of individual portfolio managers. This is the kind of active management that the data shows can actually add genuine value over time. This is the kind he himself practices and advocates. The key distinction O'Shaughnessy makes, and it is a distinction that every investor should understand deeply, is between what he calls quantitative and qualitative approaches to investing. Qualitative approaches rely on human judgment, individual analysis, personal intuition, and the kind of holistic assessment of a company's prospects that you get from reading annual reports, meeting with management, analyzing competitive dynamics, and all the other activities that traditional stock analysts perform. They are what most active fund managers use, and the data shows they do not produce better than average investment results consistently over time. Quantitative approaches, on the other hand, use mathematical rules and systematic processes to select stocks, removing human emotion and individual judgment from the equation as much as possible. O'Shaughnessy's own strategies are quintessentially quantitative. They use clear, measurable, objective factors like price-to-sales ratios and price momentum to identify which stocks to own, and they apply these factors consistently, without deviation, regardless of what the market is doing, what the news headlines are saying, or how investors are feeling about the outlook. The evidence in favor of quantitative approaches over qualitative ones is substantial and has been growing for decades. Not just from O'Shaughnessy's own research, but from a large and growing body of academic research confirming that systematic, rules-based approaches to investing consistently outperform human judgment over sufficiently long periods of time. This is not because the humans applying qualitative approaches are unintelligent or uninformed. Many of them are extraordinarily smart, deeply knowledgeable, and work very hard. It is because human judgment is subject to emotions, cognitive biases, and inconsistencies that are very hard to overcome, even with great intelligence and diligence, while a systematic rule, applied consistently and mechanically, is not subject to any of these problems. Let us now explore the idea of portfolio construction and diversification in more depth, because how you put together a portfolio of stocks is just as important as which individual stocks you choose to include. Many investors focus almost all their energy on stock selection and pay insufficient attention to portfolio construction, which is a significant mistake. O'Shaughnessy found that holding a large number of stocks, rather than concentrating in just a few favorites, significantly reduces the risk of the portfolio without significantly reducing the expected returns. This is the principle of diversification, and while it is well known in theory, many investors do not apply it sufficiently in practice. Many investors, particularly those who are excited about a small number of stocks they have researched thoroughly and feel very confident about, concentrate their portfolios in 5, 10, or 15 positions, believing that their knowledge and insight gives them an advantage that outweighs the risk of such concentration. O'Shaughnessy's data shows convincingly that this belief is almost always mistaken. The risk reduction benefits of broader diversification are so significant that a well-diversified portfolio of 50 stocks selected using a good systematic strategy will almost always outperform a concentrated portfolio of 5 or 10 stocks selected using the same strategy when measured over many years and across many different starting points. The reason is simple and mathematical. In any given year, even a very good systematic strategy will pick some losers along with the winners. If your portfolio is concentrated in 5 stocks, and 3 of them happen to be the losers in a particular year due to circumstances that no model could have predicted, your portfolio will be severely damaged. But if your portfolio is spread across 50 stocks, and 10 of them are losers in that same year, the damage is much more contained, and the strong performance of the remaining 40 stocks will more than compensate for the losses on the 10 underperformers, leaving you with an overall positive result. O'Shaughnessy recommends holding portfolios of between 25 and 50 stocks when implementing his strategies. This provides meaningful diversification across different companies, sectors, and business cycles, while still being manageable for an individual investor who wants to implement these strategies personally without the infrastructure of a large investment firm. He also recommends rebalancing the portfolio on a regular schedule, typically once a year, selling the stocks that have either risen enough that they no longer qualify as cheap based on the strategy's criteria, or that have fallen in a way that suggests their fundamental problems are more serious than originally assessed, and replacing them with new stocks that currently qualify based on the strategy's rules. This annual rebalancing is a fundamental and non-negotiable part of the strategy because it ensures that you are always holding stocks that actually meet the criteria of the system you have committed to, rather than gradually drifting into holding stocks that no longer qualify because you have become emotionally attached to them. Now, let us talk about something that O'Shaughnessy emphasizes very strongly and consistently throughout his work: the critical importance of the long-term perspective. Stock market investing is fundamentally not a short-term game, and any investor who approaches it with a short-term mindset is at a significant disadvantage from the beginning. The strategies that O'Shaughnessy identifies as the most powerful do not outperform the market every single year. In fact, as he shows clearly through his data, any strategy that is worth following will, by definition, experience extended periods of underperformance along the way. If a strategy always outperformed in every single period, every rational investor would follow it immediately, and by all following it simultaneously, they would eliminate its advantage over the market. The best strategies tend to underperform in periods when market sentiment is very strong in a particular direction. For example, when growth stocks are being chased by euphoric investors, a disciplined value strategy will. This is why O'Shaughnessy places such enormous emphasis on the need to think in terms of decades, not years or months. An investor who commits to a good strategy for 10 or 20 years and truly sticks to it through the inevitable periods of underperformance and self-doubt will almost certainly end up far wealthier than an investor who chases the latest hot strategy or jumps in and out of the market based on how the market is currently performing and how confident investors around them seem to be. The mathematics of compounding are powerful and relentless over long periods. A strategy that outperforms by even a few percentage points per year, compounded over 20 or 30 years, results in dramatically higher final wealth than a strategy that merely matches the market. This difference grows exponentially larger the longer the time period, because each year's extra return compounds on top of all the previous year's extra returns. Let me illustrate this with an example using words rather than numbers or symbols. Imagine two investors, both starting with the same amount of money, both investing over 30 years. The first investor follows a disciplined, systematic value strategy that outperforms the market by a few percentage points per year on average, but experiences more volatility and occasional painful underperformance along the way. The second investor follows the overall market return, experiencing average volatility and average returns with no particular strategy. After 30 years, the difference in final wealth between these two investors is extraordinary and life-changing because the extra percentage points of return each year have been compounding over a very long period. The first investor ends up with many times more money than the second, not because of any single brilliant decision, but because of consistent, disciplined application of a strategy that delivers a small but meaningful and persistent advantage over the market. This is the power of compounding applied to a systematic investment edge, and it is the core promise of what O'Shaughnessy demonstrates through his work. Now let us go deeper into some of the specific details of O'Shaughnessy's findings on the different value factors, because the nuances matter enormously for investors who want to actually implement these ideas in their own portfolios. Starting with the price-to-sales ratio, which O'Shaughnessy identifies as the most powerful single value factor he found in his decades of data. He tested portfolios of stocks with very low price-to-sales ratios, meaning stocks where the total market value of the company was very low relative to the company's annual revenues, and compared them to portfolios of stocks with very high price-to-sales ratios. The results were dramatic and remarkably consistent across time. Over many decades of data, the low price-to-sales portfolio significantly and consistently outperformed the high price-to-sales portfolio by a very wide margin. And the outperformance was consistent across different market environments, different economic conditions, and different time periods within the overall database. In very rough and general terms, companies that are valued by the market at less than 1 year's worth of their annual revenues are generally considered very cheaply valued. Companies valued at between 1 and 2 times annual revenues are considered moderately valued. Companies valued at more than 3 or 4 times annual revenues are generally considered expensive, and companies valued at 10 or more times annual revenues are often in the category of very expensive, requiring many years of continued rapid growth to justify such valuations. Of course, these thresholds vary meaningfully by industry, because different industries have different typical levels of profitability and different capital requirements. But as a general framework for thinking about valuation, the price-to-sales ratio provides a reliable and hard-to-manipulate baseline. O'Shaughnessy also found, importantly, that the price-to-sales factor works especially well when combined with other factors, particularly momentum. Selecting only stocks with low price-to-sales ratios that have also had positive 12-month price performance significantly improved the overall returns compared to using the price-to-sales ratio in isolation. The stocks that are both cheap and rising in price represent a fundamentally different and generally superior opportunity compared to stocks that are cheap but still declining. The rising cheap stock signals that other investors are beginning to recognize the value, while the falling cheap stock may be falling for reasons that the raw valuation ratio does not fully capture. Let us now address an important concept that O'Shaughnessy discusses with great honesty: the difference between backtesting and real-world performance, and why investors should understand this distinction carefully. Backtesting is the process of applying a strategy to historical data to see how it would have performed if you had followed it exactly over that historical period. All of the findings in O'Shaughnessy's work are based on this kind of backtesting. He takes a comprehensive database of historical stock market data and applies his strategies to that data mechanically, measuring what the returns would have been over various time periods. Backtesting is an extremely useful and important tool for understanding which strategies have worked historically and for building confidence in the logic behind those strategies. But it has real limitations that every investor should understand before putting their money on the line. One important limitation is what researchers call survivorship bias. This means that historical databases tend to include companies that survived and continued operating, while excluding companies that went bankrupt, were acquired, or were delisted from stock exchanges. This can make historical returns look better than they actually were in practice, because the worst outcomes, the complete failures, are not fully represented in the data that most researchers work with. O'Shaughnessy was aware of this limitation and took steps to minimize it in his research, including working with databases that attempted to include delisted companies. But no backtest can completely eliminate survivorship bias, and investors should keep this in mind when evaluating the historical returns that any systematic strategy claims. Another important limitation of backtesting is that markets are not static over time. As investors learn about a strategy and begin to implement it in large numbers, they may partially or fully arbitrage away some of its historical advantage. A strategy that worked brilliantly in historical data might work somewhat less well in the future, simply because too many investors are now aware of it and attempting to exploit the same patterns. This is a real and legitimate concern with O'Shaughnessy's strategies. As his book became more widely read and his findings became more broadly known in the investment community, some of the advantage of his specific strategies may have been reduced by the very popularity of the ideas he was promoting. However, O'Shaughnessy would argue, and the evidence does support this argument, that the psychological difficulty of implementing these strategies provides a natural and powerful protection against their advantage, being fully arbitraged away by informed investors. Because the strategies require investors to do things that feel deeply counterintuitive and emotionally uncomfortable, such as buying unloved stocks that have fallen in price and selling popular stocks that have risen dramatically, many investors who know about the strategies simply cannot bring themselves to implement them consistently over time. The discomfort of being different from the crowd, of underperforming in periods when everyone else seems to be making money easily, causes most investors to abandon systematic approaches at some point, even when they intellectually believe in the long-term logic. This means that the advantage of good systematic strategies tends to persist over time, even as the knowledge of those strategies becomes more widespread. Let us now discuss something O'Shaughnessy calls the concept of factors and how they can be combined most effectively. In recent years, the investment world has increasingly adopted a framework called factor investing, which is essentially what O'Shaughnessy was doing decades before the terminology became standard in the industry. Factor investing recognizes that certain measurable characteristics of stocks, called factors, are systematically associated with higher than average long-term returns. The most well-studied and validated factors include value, which we have discussed extensively and which O'Shaughnessy's research strongly confirms, momentum, which we have also discussed in detail, quality, which refers to factors like high profitability, strong and stable earnings, and strong balance sheets with low debt, size, which refers to the historical tendency of smaller companies to outperform larger ones over very long periods, and low volatility, which refers to the somewhat counterintuitive tendency of stocks with low price volatility to outperform high volatility stocks over time, despite the conventional finance theory that higher risk should produce higher returns. O'Shaughnessy's research was ahead of its time in identifying and rigorously validating several of these factors, particularly value and momentum, using comprehensive long-term data. His finding that the price-to-sales ratio is the most powerful single-value factor has been confirmed and validated by subsequent academic research and has become an important reference point in the broader factor investing literature. The implication for investors is both important and actionable. By systematically tilting your portfolio towards stocks with favorable factor characteristics, meaning stocks that score well on value, momentum, and quality measures, you can expect to earn higher returns over the long run than investors who simply buy the whole market or who chase hot trends without any systematic framework. But the tilts need to be applied consistently, mechanically, without emotional override, and maintained over long periods, through good times and bad, including through periods when the factor you are following is out of favor with the market. Let us now address the question of what happens when you put multiple factors together in a single strategy. O'Shaughnessy tested many different combinations of factors and found that combining them thoughtfully generally produced better and more consistent results than using any single factor alone. The reason is intuitive once you think about it. Different factors capture different dimensions of what makes a stock an attractive investment. A stock that is cheap based on price-to-sales ratio and also growing its earnings strongly and also showing positive price momentum represents a fundamentally more compelling and more robust opportunity than a stock that is simply cheap based on price-to-sales ratio alone, but declining in price and showing no earnings growth. All three conditions together create a much higher probability situation. The specific combination that O'Shaughnessy found most powerful for smaller stocks was combining a low price-to-sales ratio with strong earnings growth and positive price momentum. This combination identifies companies that the market has priced cheaply relative to their revenues, that are actively growing their business, and that investors are beginning to reward with rising stock prices. When all three of these conditions align simultaneously, the expected future returns are substantially and reliably higher than when only one or two of them are present. For larger stocks, O'Shaughnessy found that combining multiple value factors simultaneously, such as high dividend yields, low price-to-earnings ratios, low price-to-cash flow ratios, combined with positive price momentum, was the most effective approach. Large companies that look cheap across several different value measures at once represent an especially compelling value opportunity because the cheapness is confirmed by multiple independent measures rather than just one, which reduces the risk that any single measure is being distorted by accounting or industry-specific factors. One of the strategies O'Shaughnessy discusses in detail is a well-known strategy called the Dogs of the Dow. This is a simple strategy developed well before O'Shaughnessy's research, but that illustrates the basic value investing principle clearly. The strategy involves selecting the 10 stocks within the Dow Jones Industrial Average, which is an index of 30 of the largest and most prominent companies in the United States that have the highest dividend yields at the beginning of each calendar year. The idea is that these stocks, being the highest yielding among 30 of the market's biggest companies, are the most out of favor with investors at that moment, and therefore represent the best value opportunity among that universe of large, established businesses. O'Shaughnessy tested this strategy against his comprehensive historical data and found that it does tend to outperform the Dow Jones Industrial Average itself over long periods of time, though it underperforms the best of his own multi-factor strategies. Nevertheless, it is a simple, transparent, and relatively easy to implement strategy that clearly illustrates the core principle of value investing, buying the out of favor and waiting patiently for the market to eventually recognize their value. The Dogs of the Dow strategy has the great practical virtue of simplicity. You only need to own 10 stocks at a time. You only need to rebalance once a year at the same date, and the criteria for which stocks to select are absolutely clear and completely objective. This makes it much easier for most individual investors to actually stick with the strategy through periods of underperformance, which helps offset its somewhat lower potential returns compared to the best of O'Shaughnessy's more sophisticated strategies. Now let us talk with great depth about the psychological challenges of implementing any long-term investment strategy, because O'Shaughnessy considers this to be perhaps the most important single topic in his entire body of work. Understanding a strategy intellectually is one thing. Actually following it through real-world market conditions that test your confidence and patience is something else entirely. Imagine you have decided to follow a disciplined value strategy, buying the stocks with the lowest price-to-sales ratios in the market and holding them for a year before rebalancing. In the first year, the strategy does reasonably well. In the second year, it does even better. You are feeling confident and validated in your approach. But then comes a period, like the late 1990s, the peak of the great technology bubble, when technology stocks are soaring to extraordinary heights, and every value stock is being ignored or actively sold by investors who are chasing the growth story. In such a period, your value strategy will dramatically underperform the overall market. Your portfolio of cheap, boring, out-of-favor companies will be going nowhere or even declining, while your neighbor is enthusiastically telling you about how his technology stocks have tripled or quadrupled in value. This is the moment that breaks most investors' discipline and commitment to their strategy. The fear of missing out, the uncomfortable feeling of being left behind while others seem to be getting rich easily, the social pressure of seeing people around you making enormous gains from a completely different approach, all of these powerful psychological forces combine to push investors toward abandoning their strategy at exactly the worst possible moment. And what happens next? The technology bubble bursts, and the previously soaring growth stocks fall by truly catastrophic amounts over the following years, while the boring value stocks hold up comparatively well and then recover strongly. The investor who abandoned the value strategy at the peak of their discomfort locks in the underperformance and completely misses the subsequent recovery. The investor who maintained their discipline and stuck with the strategy through the painful period ends up far ahead over the full cycle. O'Shaughnessy uses this and many other historical examples from his data to illustrate what may be the single most important point in all of investing. Every strategy, no matter how thoroughly researched, how well validated by historical data, and how logically sound, will experience extended periods of underperformance. The length and severity of these periods cannot be predicted in advance. They could last 1 year, or they could last 2 or 3 years, or even longer in some cases. The only way to ultimately capture the long-term advantage of a good strategy is to maintain discipline and stick with it through these difficult and doubt-inducing periods, which requires a level of emotional fortitude that most investors, if they are honest with themselves, simply do not possess without significant mental preparation and ongoing commitment. How can investors develop this level of discipline and maintain it over the decades that successful systematic investing requires? O'Shaughnessy suggests several interconnected approaches. First, develop a genuine and deep understanding of why your strategy works at a fundamental level. If you truly understand the underlying economic and behavioral logic, if you can explain in your own words exactly why cheap stocks tend to outperform expensive ones over time, and why this effect should persist in the future, you are much better equipped to maintain your commitment to the strategy when it is underperforming, because you understand that the underperformance is almost certainly temporary and the underlying logic remains sound. Second, mentally prepare yourself for extended periods of underperformance before they actually arrive, so you are not caught off guard. Recognize before you begin that these periods are not signs that the strategy has broken or become invalid, but rather they are a normal and expected part of the cycle of any good systematic approach. Third, maintain a genuine long-term perspective at all times, particularly in moments of short-term pain. When you are feeling frustrated and discouraged about short-term underperformance, deliberately remind yourself that you are playing a game that lasts decades, not months, and that short-term discomfort is the price of long-term outperformance. Fourth, and this is perhaps the most practically powerful suggestion, avoid constantly monitoring your portfolio's performance against a benchmark or against what others are earning. The more frequently you check how your strategy is performing relative to the overall market or relative to what hot strategies are earning, the more likely you are to be tempted to make emotionally driven changes based on short-term performance comparisons. O'Shaughnessy recommends reviewing your strategy's performance no more than once a year, at the time of your scheduled annual rebalancing, and resisting strongly the temptation to monitor performance more frequently or to make adjustments outside of that annual schedule. Now let us talk about the broader implications of O'Shaughnessy's work for investors at different life stages and with different financial circumstances, because the practical application of these ideas depends significantly on your specific situation. For younger investors who are just beginning to save and invest for the long term, O'Shaughnessy's findings point toward a powerful opportunity. Time is the most valuable asset in all of investing because of the compounding effect we discussed earlier, and younger investors have more of it than anyone else. Even a small amount invested consistently in a good systematic strategy starting in your 20s will grow to a significantly larger amount over a working career of 30 or 40 years than the same amount invested starting in your 40s. The earlier you start, the longer your time horizon, and the more powerful the compounding of any systematic edge becomes over time. For middle-aged investors who are building their wealth in the prime years of their career, the most important considerations are maintaining a long enough time horizon to allow the strategies to work through their inevitable cycles, and ensuring that the portfolio is not so concentrated in any single strategy or asset class that a period of underperformance causes serious financial damage. Diversifying across multiple strategies that have different characteristics, for example, combining a value strategy with a momentum strategy that tends to perform well at different times, can help smooth the overall portfolio experience and make it easier to stay the course. For investors who are approaching or already in retirement, the considerations become somewhat more complex. While the core principles of systematic investing remain valid, the need to generate income from the portfolio and the shorter remaining time horizon for recovery from potential downturns both need to be factored in. O'Shaughnessy's strategies, particularly the cornerstone value strategy focused on large-cap stocks with high dividend yields, can be particularly appropriate for investors in or near retirement because the high dividend income provides regular cash flow, and the focus on large, established companies tends to produce somewhat lower volatility than the small-cap growth strategies. An important caution that O'Shaughnessy makes repeatedly throughout his work is about the extreme danger of second-guessing the systematic strategy you have committed to. When the strategy selects a stock that you personally know something negative about, when the news is full of alarming stories about one of your strategy's current holdings, when the stock of a company you own has just fallen sharply on disappointing news, the temptation to override the system and sell that stock outside of your normal rebalancing schedule is overwhelming. O'Shaughnessy's data shows clearly and consistently that this kind of override, driven by current information and emotional reaction, is almost always a mistake over the long run. The human tendency is to override the system at exactly the wrong times, eliminating the potential gains precisely when the strategy is about to generate them, and adding to positions or avoiding sales at times when those actions turn out to be wrong. This is perhaps the most counterintuitive and psychologically difficult aspect of systematic investing. Trusting a mathematical process over your own current judgment, even when you feel very confident about your assessment of a specific situation, is extraordinarily difficult for most people. We are trained by education and experience to believe that we can add value through careful thinking and informed judgment. The data says that in the context of stock market investing, this belief is almost always wrong, and that the more confident you feel about a specific judgment that deviates from your systematic strategy, the more likely you are to be subject to the very cognitive biases that make individual stock picking so unreliable. Let us now discuss the concept of market efficiency and how O'Shaughnessy's work relates to the academic theories that have dominated finance for many decades. The efficient market hypothesis, which has been one of the most influential ideas in all of financial economics, says that in a truly efficient market, all publicly available information is already fully reflected in stock prices, making it impossible to consistently earn returns above the market average through any form of active stock selection. If this theory were completely true, O'Shaughnessy's strategies could not work, because all the information contained in price-to-sales ratios, momentum figures, and other factors would already be fully priced into stocks by rational investors who had noticed these patterns. O'Shaughnessy's work, along with a large and growing body of academic research, suggests that markets are not perfectly efficient, particularly in the ways relevant to behavioral finance. While markets are very efficient at incorporating factual news and information about companies quickly, they are systematically inefficient in ways that are driven by human psychology. Investors systematically overreact to recent events, extrapolating short-term trends too far into the future. They systematically underweight fundamental valuation measures when they conflict with exciting narratives about growth and innovation. And they systematically follow the crowd rather than thinking independently, which creates persistent patterns of overvaluation in popular stocks and undervaluation in unloved stocks that a disciplined, systematic investor can exploit over time. These systematic inefficiencies are not easy to exploit because doing so requires doing the exact opposite of what feels comfortable and natural. But they are persistent because the psychological forces that create them are fundamental to human nature and are not going to disappear simply because some investors know about them intellectually. This is why O'Shaughnessy's strategies and the broader family of factor-based investing strategies that his work helped pioneer have continued to show evidence of working even as they have become more widely known. The knowledge is widespread. The discipline to act on that knowledge consistently is rare. Let us now talk about what O'Shaughnessy says about the role of innovation and technology in the stock market, because this is a topic that confuses many investors who conflate the quality and potential of a technology or innovation with the attractiveness of the stocks of companies developing that technology. This is one of the most common and costly mistakes in investing. The history of the stock market is full of examples where enormous technological innovations created fantastic value for society and for the economy as a whole, while simultaneously destroying value for most investors in the companies that developed those innovations. The reason is always the same. When investors become excited about a transformational technology, they pay prices for the stocks of companies developing it that are so high that the stocks cannot possibly deliver good returns, even if the technology succeeds exactly as hoped. The classic historical example is the railroad industry. Railroads were genuinely transformational, connecting markets and enabling economic growth in ways that were difficult to overstate. But most investors in railroad stocks in the 19th century lost money because they paid too much for the stocks, even though the underlying technology succeeded spectacularly. The same story has been repeated with the automobile industry, the airline industry, the internet in the late 1990s, and many other transformational technologies throughout market history. O'Shaughnessy's data confirms this pattern clearly. The most exciting and rapidly growing sectors of the economy are usually among the worst places to invest because the excitement and enthusiasm of investors drives prices to levels that cannot be justified by the actual subsequent business performance, even in the most optimistic scenarios. The best investment returns come from the overlooked, the boring, the temporarily out of favor, not from the exciting and cutting edge. This is a deeply counterintuitive finding, but it is one of the most consistent patterns in all of the historical data. Now let us talk about the important role of dividends in a long-term investment strategy, because O'Shaughnessy's data reveals some important and often underappreciated truths about dividends. Many investors focus almost entirely on capital gains, meaning the appreciation in the price of stocks over time, and pay relatively little attention to dividends, the regular cash payments that many companies make to their shareholders. But the historical data shows that dividends are a very important component of total stock market returns over long periods. A significant portion of the total return from stocks throughout history has come from dividends, not just from price appreciation. And companies that pay consistent and growing dividends tend to have certain characteristics that are associated with long-term investment success, including financial discipline, stable cash flow generation, and a commitment to returning value to shareholders rather than wasting capital on low-return investments. O'Shaughnessy found that high dividend yield is a valuable valuation signal, one of several factors that together indicate a stock is genuinely cheap and potentially attractive. As mentioned earlier, the dogs of the Dow strategy relies primarily on dividend yield as its selection criterion and has produced reasonably good results over time as a result. But O'Shaughnessy found that dividend yield works best not in isolation, but as one of several complementary value factors used together to identify the most attractively valued stocks in the market. Let us now address a very important question that many investors ask, the question of what to do during a major market crash. Every investor knows that stock markets can fall dramatically and quickly. In major bear markets, diversified stock portfolios can fall by 30, 40, or even 50% from their highs in a relatively short period of time. When this happens, the psychological pressure to sell and move to cash, to wait for things to stabilize before reinvesting, is enormous. Every instinct, every daily news report, and seemingly every financial commentator may be telling you to get out. What does O'Shaughnessy's data say about this situation? The data says, stay invested and stick to your strategy. This is perhaps the hardest advice in all of investing to follow when markets are falling sharply and fear is widespread, but it is also among the most clearly supported by historical evidence. The reason is that major market recoveries tend to happen quickly and without warning. If you are out of the market when the recovery begins, missing just the first few weeks or months of a powerful recovery can dramatically reduce your long-term returns. And because no one can reliably predict when the recovery will begin, investors who move to cash during a crash almost always end up reinvesting too late after prices have already recovered significantly from the lows. The historical data also shows something that is counterintuitive but important. During and immediately after market crashes, the returns of systematic value strategies tend to be especially strong because the crash creates exactly the kind of extremely cheap valuations that value strategies are designed to identify and exploit. The investor, who not only stays invested during a crash, but actually rebalances into the most beaten-down value stocks at the bottom of the market, tends to generate spectacular returns over the following years. Of course, this requires a level of courage and conviction that almost no investor actually has at the bottom of a market panic. But even simply staying invested, without any additional heroics, dramatically outperforms moving to cash during downturns and missing the subsequent recovery. Let us now discuss what O'Shaughnessy's work reveals about the best approach for an investor who is just starting to put these ideas into practice, someone who has understood the logic, committed to the approach, and is now ready to actually implement a systematic strategy with real money. The first practical step is to define clearly which strategy or combination of strategies you are going to follow. This decision should be based on your time horizon, your tolerance for volatility, and the practical constraints of your investing situation, such as the tax treatment of your accounts and your access to the data and tools needed to implement the strategy. For someone with a long time horizon, high tolerance for volatility, and access to good financial data, the cornerstone growth strategy, or a similar multi-factor strategy combining price to sales, earnings growth, and momentum might be appropriate. For someone with lower tolerance for volatility or a shorter time horizon, the cornerstone value strategy focused on large-cap stocks might be a better fit. The second practical step is to gather the data you need to identify the stocks that currently qualify based on your chosen strategy's criteria. This data is available from various financial data providers and websites that cover stock fundamental information. You need, at minimum, stock prices, annual revenues, and annual earnings for each stock in your investment universe. For momentum-based filters, you also need the 12-month price change for each stock. Once you have this data, ranking the stocks by your chosen criteria is straightforward, though time-consuming if done manually. The third step is to build the initial portfolio by selecting the stocks that rank highest on your chosen criteria, and buying roughly equal amounts of each. As mentioned, holding between 25 and 50 stocks provides meaningful diversification without making the portfolio unmanageable. The fourth step, perhaps the most important of all after the initial purchase, is to commit to and follow the annual rebalancing schedule, and to not make any changes to the portfolio outside of that annual schedule, regardless of what happens in the market or what news emerges about individual holdings. Write the rebalancing date in your calendar. Consider it as fixed and non-negotiable as any other important commitment. And on that date, and only on that date, review the portfolio, sell the stocks that no longer qualify based on the criteria, and replace them with stocks that currently qualify. Now let us discuss what O'Shaughnessy says about the relationship between economic cycles and investment strategy, because many investors try to adjust their approach based on where they think we are in the economic cycle. Should you be more aggressive when the economy is strong and more defensive when it is weak? Should you shift toward growth stocks in a boom and value stocks in a recession? O'Shaughnessy's answer, supported by his data, is a clear no. He found that the performance of different systematic strategies does vary somewhat across different economic environments, but that this variation is not predictable enough in advance to make tactical shifts worthwhile. By the time you know you are in a recession, the market has usually already fallen significantly, and the adjustment you wanted to make is no longer helpful. By the time you know the economy is recovering strongly, the market has usually already risen substantially, and the tactical shift into more aggressive positions is actually buying into higher prices. The data consistently shows that sticking to a single, well-defined systematic strategy through all economic environments generates better long-term results than trying to time shifts between strategies based on economic conditions. The benefits of tactical flexibility in theory are more than offset by the costs of getting the timing wrong in practice. O'Shaughnessy also addresses the question of inflation and its impact on systematic investment strategies. High inflation environments, where the prices of goods and services are rising rapidly, can be challenging for many types of investments, including stocks, because rising inflation typically leads to rising interest rates, which increases the discount rate applied to future earnings and makes stocks worth less in present value terms. But even in high inflation environments, the historical data shows that systematic value strategies tend to hold up reasonably well relative to the broader market, in part because the high dividend yields and low valuations of value stocks provide a natural buffer against the adverse effects of rising interest rates. Let us now talk about what O'Shaughnessy says about the concept of quality in investing, because this is an important dimension that goes beyond simple valuation measures. Quality factors attempt to identify companies that are not just cheap, but are also fundamentally sound businesses with strong financial characteristics that make them likely to sustain and grow their value over time. The most important quality factors that O'Shaughnessy discusses include return on equity, which measures how efficiently a company generates profits from the money that shareholders have invested in it, debt levels relative to assets or earnings, which measure the degree of financial risk a company is taking and how vulnerable it might be to an economic downturn or financing challenge, the consistency of earnings over time, which measures whether a company's profits are stable and predictable or highly variable and unpredictable, and the rate of share issuance, meaning whether a company is creating new shares, which dilutes existing shareholders, or buying back shares, which concentrates ownership and is generally a sign of financial strength. O'Shaughnessy found that combining quality factors with value and momentum factors produces some of the most consistently strong results in his entire research database. The intuition is straightforward and compelling. A company that is cheap relative to its fundamentals, that is also financially sound, generating strong returns on equity, carrying manageable debt, and showing consistent earnings, and that is also showing positive price momentum as investors start to recognize its value, represents about as attractive an investment opportunity as systematic investing can identify. You are buying a good business at a discount to its true value, with a tailwind of improving investor sentiment behind it. These three things together create the conditions for strong future returns with a relatively low risk of permanent loss. Let us now revisit and expand on the concept of rebalancing, because it is so central to implementing any systematic strategy effectively over time, and yet is something that many investors either do not do or do not do correctly. Annual rebalancing serves multiple important functions simultaneously. First, it keeps the portfolio aligned with the strategy's criteria at all times, ensuring that you are always holding stocks that currently qualify based on the systematic rules you have chosen. Without rebalancing, the portfolio gradually drifts away from its original criteria as some stocks appreciate into expensive territory and others fall into cheap territory without being replaced. Second, rebalancing naturally implements a buy low, sell high approach at the portfolio level because it forces you to sell stocks that have risen enough to no longer be cheap and to replace them with stocks that are currently cheap. This is exactly the right thing to do systematically, even though it feels wrong emotionally, because you are selling your winners and buying your losers. Third, rebalancing helps manage overall portfolio risk by periodically trimming positions that have grown large due to strong appreciation and redistributing that capital into smaller. The one major caveat about annual rebalancing is the tax and transaction cost implications we discussed earlier. Every time you sell a stock that has appreciated, you may owe taxes on the gain in many jurisdictions, and every buy and sell transaction incurs transaction costs, even when those costs are very small in modern trading environments. For this reason, O'Shaughnessy recommends implementing systematic strategies in tax-advantaged accounts wherever possible to allow the strategy to compound without the drag of annual tax bills on rebalancing gains. Let us now reflect on some of the broader philosophical implications of O'Shaughnessy's work, because they go beyond the practical questions of which stocks to buy and how to construct a portfolio. One of the deepest and most important implications is about the nature of knowledge and expertise. We live in a culture that deeply values expertise, the idea that years of experience, careful study, and intelligent analysis lead to better judgment and better outcomes. In most fields of human endeavor, this is true. A surgeon with 30 years of experience is better than a recently qualified surgeon. An architect who has designed hundreds of buildings is more capable than one who has designed only a few. Experience and expertise genuinely matter in most complex human activities. But investing is an exception, a fascinating and important exception. In investing, more experience and more information do not necessarily lead to better outcomes, because the additional information often gets filtered through the same cognitive biases and emotional reactions that plague all human decision-making. In fact, more experience can sometimes lead to more overconfidence, which is one of the most dangerous states for an investor to be in. The data consistently shows that systematic rules-based approaches, which require no particular expertise or experience to apply mechanically, outperform expert human judgment over long periods. This is a genuinely surprising and counterintuitive finding with profound implications for how we think about expertise, knowledge, and decision-making in complex systems. Another important philosophical implication concerns the nature of humility in investing. The most successful systematic investors, including O'Shaughnessy himself, are deeply humble about the limits of their ability to predict the future. They do not claim to know which specific stocks will outperform next year, or where the market will be in 6 months, or when the next recession will begin. What they claim, and what their data supports, is only that certain systematic approaches to selecting stocks have produced higher than average returns over long periods in the past, and that there are good reasons to believe they will continue to do so in the future. This is a very modest claim compared to what most active investors and most financial commentators believe about their own forecasting abilities. This humility is not weakness, it is strength. An investor who acknowledges the limits of their knowledge and builds a portfolio accordingly, using systematic rules to make decisions rather than relying on their own uncertain forecasts, is in a much stronger position than an investor who is confident in their ability to predict the unpredictable. The humble systematic investor makes better decisions on average, not because they are smarter, but because they are not undone by overconfidence. Let us now bring together everything we have discussed into a practical and comprehensive framework that any investor, anywhere in the world, can use to think about and approach the stock market more intelligently. The foundation of everything is the commitment to making decisions based on data and systematic rules rather than on emotions, instincts, or the advice of individuals whose track records do not justify the confidence placed in them. This commitment needs to be genuine and deeply held, not just a surface-level intellectual agreement, because it will be tested severely and repeatedly by the real-world experience of investing through different market conditions. Building on this foundation, the core investment approach should be centered on value factors, with the price-to-sales ratio as the primary valuation measure, supplemented by other value factors like price-to-earnings, price-to-book, and dividend yield to provide a more complete picture of valuation. The goal is to consistently own stocks that are genuinely cheap relative to their fundamental business metrics, not stocks that merely feel cheap after falling in price. To this value core, add a momentum filter that screens out stocks that are cheap but still declining in price, keeping only those that show positive price performance over the past 12 months. This combination of value and momentum dramatically improves the quality of the portfolio compared to value alone by filtering out the value traps that are cheap for genuinely bad reasons and keeping only those that are beginning to attract positive attention from other investors. Then, add quality filters to further improve the portfolio, focusing on stocks with strong return on equity, manageable debt levels, and consistent earnings, which increases the confidence that the cheap valuations are genuine opportunities rather than reflections of fundamental business problems. Build the portfolio with enough individual stocks, at least 25, and ideally closer to 50, to ensure that no single stock failure can cause serious damage to the overall portfolio. Weight the positions roughly equally to give each opportunity an equal chance to contribute to returns. Commit to an annual rebalancing schedule and stick to it absolutely, selling stocks that no longer qualify and replacing them with stocks that do, regardless of how you feel about either the stocks being sold or those being purchased. Implement the strategy in tax-advantaged accounts to the extent possible to minimize the tax drag on annual rebalancing. Adopt a very long-term perspective from the beginning, understanding and accepting that you will experience periods of underperformance that last for 1, 2, or even 3 or more years, and that these periods are normal, expected, and actually necessary features of any strategy that will ultimately outperform over the long run. Do not monitor your performance against benchmarks more frequently than once a year. Do not make changes to your strategy based on short-term performance results. And maintain the intellectual and emotional commitment to the strategy by regularly revisiting the evidence base, the decades of historical data that supports the approach, so that the discipline you need in difficult moments is grounded in real knowledge and genuine conviction rather than blind faith. These principles, taken together, represent a comprehensive and evidence-based framework for successful long-term stock market investing. They are accessible to any investor who is willing to commit to them. They do not require special knowledge of accounting or economics. They do not require access to proprietary information or sophisticated financial models. They require only data, discipline, and time. But those three things, properly combined, are enormously powerful. As we come toward the conclusion of this exploration of O'Shaughnessy's landmark work, it is worth stepping back and reflecting on the bigger picture of what he has demonstrated and why it matters so much for every investor. What O'Shaughnessy ultimately showed, through years of painstaking data analysis applied to decades of market history, is that the stock market is not a random and completely unpredictable system where only the lucky few win. It is a complex system that responds to fundamental forces of value, growth, sentiment, and momentum in ways that are somewhat predictable over long periods of time, even if they are not predictable in any given month or quarter. By understanding these forces and systematically exploiting them through disciplined investing, disciplined investors can earn returns that are significantly better than average without extraordinary intelligence, without privileged access to inside information, and without devoting their entire professional life to studying the market. This is perhaps the most hopeful and democratizing finding in all of the vast literature on investing. You do not need to be a genius to succeed in the stock market over the long run. You do not need to be connected to powerful people who know things others do not. You do not need to devote all of your waking hours to analyzing companies and reading financial statements. You need a proven strategy grounded in decades of evidence, the discipline to follow it consistently, regardless of how uncomfortable it feels at any given moment, and the patience to wait for it to work over a time horizon that most investors are unwilling or unable to maintain. These things are genuinely within the reach of any investor who is willing to commit to them sincerely. The challenge, as always, lies in the psychological domain. Understanding the strategy is easy. Believing in it intellectually is relatively easy. Following it faithfully through periods of pain, embarrassment, and apparent failure, through years when everyone around you seems to be making money from approaches that the data says are inferior, through market crashes that make every rational voice say to sell everything and wait, is the genuinely hard part. And this is where O'Shaughnessy's real and lasting contribution to the world of investing lies, not just in identifying which strategies work and why, but in providing investors with the comprehensive historical evidence and the deep conceptual understanding they need to maintain their conviction through those difficult and testing periods. When your value strategy is underperforming for the second or third consecutive year, and the financial press is declaring that value investing is dead, and growth is the only way to invest, and your colleagues are making easy money in a booming sector, while your portfolio sits flat or declines, you will be tempted with every fiber of your being to abandon ship and join the crowd. But if you have internalized O'Shaughnessy's findings deeply and genuinely, you will remember that this exact scenario has played out before, many times, throughout the long history of markets. You will remember that the periods of worst underperformance for value strategies are often immediately followed by the periods of their strongest performance, as the excesses of popular growth investing inevitably correct. You will remember that the investors who stayed the course, who endured the social discomfort and the portfolio pain of being different from the crowd, are the ones who ended up with dramatically more wealth at the end of the cycle. And with that deeply held knowledge and genuine conviction, you will hold on. That is the ultimate and most valuable gift of what O'Shaughnessy has given to the investing world. Not a set of magical formulas that will make you rich quickly or effortlessly. Not a secret that powerful insiders are trying to keep from ordinary investors, but a comprehensive, rigorously tested, honestly presented framework for thinking about investing that, if truly internalized and consistently applied with discipline over many years, can make a profound and life-changing difference in your long-term financial outcomes. It is a framework built entirely on data rather than on opinions, on discipline rather than on emotion, and on the long view rather than on the short one. For any investor who is genuinely serious about growing their wealth over the long term, who is willing to challenge their comfortable assumptions, who is willing to learn honestly from the historical evidence, even when that evidence contradicts what feels natural and right, and who is willing to commit to a systematic approach through good times and bad. This work, and the ideas it contains, offer an extraordinarily valuable education and an extraordinarily powerful set of tools. The ideas are not always comfortable. They sometimes go directly against what feels natural, against popular wisdom, and against the advice of many well-meaning commentators and advisors. But the data is clear, consistent, and compelling across many decades and many different market environments. And the long-term results, for those disciplined enough to follow these principles, are consistently and meaningfully better than the results of those who do not. So as you go forward and think about your own investment approach, as you consider where to put your money, how to build your portfolio, and how to manage it through all the inevitable ups and downs that lie ahead, keep returning to the fundamental insights that O'Shaughnessy's research illuminates so powerfully and so clearly. Buy cheap rather than expensive. Favor value measured by real business fundamentals, with price to sales as your most powerful single measure. Use price momentum as a confirming filter to avoid falling knives and value traps. Own enough different stocks to be truly diversified. Rebalance on a fixed annual schedule without deviation. Stay fully invested through market cycles. Control your emotional reactions to short-term performance. Minimize your costs. Ignore economic forecasts and market timing predictions. And start as early as you possibly can, because time is your greatest ally in the compounding game. These principles will not make you rich in a week or a month or even a year, but applied consistently, with genuine discipline and genuine patience over the years and decades that long-term wealth building actually requires, they give you the best possible chance of achieving the financial security and the financial freedom that every investor is ultimately working toward. That is what the data shows works on Wall Street. And with this understanding firmly established in your mind and your heart, it can now begin to work for you too, wherever in the world you are, and whatever the size of your current portfolio. The journey of building wealth through disciplined investing is one that never truly ends and never stops requiring vigilance and commitment. But it is also a journey that, with the right framework and the right mindset, becomes increasingly rewarding over time, not just financially, but in the sense of mastery and understanding that comes from engaging seriously with one of the most fascinating and consequential systems in the modern world. The stock market, understood correctly and approached systematically, is not a source of anxiety and uncertainty. It is an extraordinary, wealth-building machine, one that has created enormous prosperity for disciplined long-term investors throughout history, and that will continue to do so for those who approach it with the wisdom, the patience, and the discipline that O'Shaughnessy's decades of research so powerfully illuminate.